This is not sound policy. The way you grow is people learn, they grow up, parents invest in them, they invest in their education, they learn, companies invest in them, they get more productive, they earn more, they spend more. That's how you get a real boom. Technologies emerge, as I said earlier, slightly different cycle. They come in, how do we live without personal computers, for crying out loud? What can we do today that we couldn't do in the 70s or 60s before that? What did they do before TV and automobile? I mean, these things are mammoth.
In today's video, Harry Dent, author of 0 Hour, talks about what's up with bonds, the next moves of the Fed, the raging inflation and the coming recession. Dent has been predicting a great reset of the biggest financial asset bubble in history. The market historian predicted a painful crash in stocks and an economic depression, and discusses the next moves before the big crash. He believes that the top is in and the Fed is tightening aggressively. Could the markets make a new high? Before listening to him, please ensure to smash the like button and subscribe to the channel.
Now, the technology cycle just peaked in 2020. That's an important cycle. That has peaked as well. The geopolitical cycle's been down for many decade and a half. It is only starting to turn up, so about to be a bright spot, but nowhere there yet. We're in the worst fundamental place in our economy since we've been in the early 80s and in the early 1930s, and really more like the early 1930s. This is why governments have been printing money. They're covering over, hoping the economy will get its mojo back and then come back, and it never does. Now, so what just happened? Here's the most important thing, and chew on this for a minute. So we get COVID after all this. Okay, that's what we need. COVID, the global virus going around, slowing everything down, keeping people from going to work, socializing, blah, blah, spending money. Oh, yuck. Well, that's when the central banks, particularly the Federal Reserve in the United States, really panicked. Now listen to this number. I had to check everything twice when I looked at it a couple of years ago. Between fiscal stimulus, which they haven't been doing for a long time, and monetary stimulus, which just simply been accelerating since the 2009 bottom, March 2009, printed $10 trillion in the U.S. alone. In 2 years, that's 46% of GDP. What? People don't know this. That's insanity. That is desperation. And you think, hey, if we were growing at 10% in the best economy, here we are 2 years later, and the economy's going into recession. And after this much stimulus, 10 trillion, 46% of GDP, we're already about to fall back in recession. So now they're looking at, well, now we need stimulus. But no, they have to tighten. Why do they have to tighten? Because they created an unexpected and non-fundamental sharp surge in inflation. Now, they've been printing money since 2009. We already know that. All the gold bugs are always saying, oh, it's going to cause inflation. No. Because workforce growth, the real indicator for inflation, and I've got the best inflation indicator in the world, and it says we've been going down since 1980, and we should be at about 1% today, and we'll be somewhere 1-2%, 0 to 2 for as far as you can see. Inflation's dead because workforce entry is slowing around the world. Why workforce entry for inflation? Because it costs a fortune to raise a kid and then incorporate them in the workforce, and the last people are businesses that have to get them an office and training. So we have this spike in inflation, and now it calls their bluff. Now they're forced to tighten. Now, what's Jerome Powell in the United States and central bankers thinking? Hey, economy's been strong. Yeah, inflation's out of control. We can handle this. I am predicting we can't handle this because my real indicator, the spending cycles of generations, the spending wave, says we're still going into the bottom of a downturn in natural spending that started in 2008 and will not turn up until 2024. So this is a time when the fundamentals are still weak, and all we need is something to go wrong, and we could be in a crash faster than governments can counter, okay? That's the trick, because it is hard to fight central banks when their ethos starting with Mario Draghi, by the way. He's the first guy that when the crisis happened in 2008-9 in Europe, he said, you want to be a short seller and bet against our countries? I will blow you out of the water. I will print enough money to blow you short sellers out of the water. Well, they've been doing that ever since, okay? This is not sound policy. The way you grow is people learn, they grow up, parents invest in them, they invest in their education, they learn, companies invest in them, they get more productive, they earn more, they spend more. That's how you get a real boom. Technologies emerge, as I said earlier, slightly different cycle. They come in, how do we live without personal computers, for crying out loud? What can we do today that we couldn't do in the 70s or 60s before that? What did they do before TV and automobile? I mean, these things are mammoth, what technologies do. But technologies emerge slowly in niche markets because they're very expensive. People don't understand them. They're scared of them at first. And they hit the 10% on the S-curve and they mushroom. The S-curve makes technologies very highly projectable once you hit that 10% point for the rest of their life cycle. And my demographic research makes generational spending very predictable. Again, we don't get into a positive economy on all these cycles, particularly the generational one that's been down the longest and hardest, okay? We don't get there till 2024. And then it's different by country. And then we don't have time. I can throw up the spending wave and projections for any country in the world. Oh, let's see. What's the number one? Let me think about that for a minute. What the hell's the number one country? Oh, it's Australia. It's you guys. A wealthy, affluent country, not quite as affluent in income as the U.S., but you guys have good demographics. Where does it come from? You're not having more babies than we are. You get the highest quality immigrants. We get Mexicans running, a lot of them illegally across the border. You get high quality Asian immigrants. Higher quantity of immigration than we get in the United States and Europe, and higher quality of immigrants. You have the golden formula. You are one of 5 developed countries, small like Norway and Sweden, and your cousin New Zealand, but you're the strongest. You have the strongest demographic spending trends of any developed country in the world, Australia. So what's your problem? Anybody guess? How's your housing prices? You have the second most overvalued compared to income housing prices in the world, second only to China. And China's real estate bubble is already unraveling, which has to. They're way poorer than us. And you know, some Chinese households have 2 extra homes that are sitting empty because that's how they speculate instead of buying stocks like we do in the US or somewhere else. This is insanity, okay? So China is the biggest real estate bubble in the world. United States has the biggest stock market bubble in the world. And all of these bubbles are going to have to deflate because they weigh on the economy. Money velocity is the telltale sign. If I had to take one indicator that everybody should know about, it's money velocity. And Lacey Hunt's the only economist I see talk about it and explain it properly. The most important single factor. How are we investing in the future, and how productively? This is a direct measure. And this is saying we've been going in the wrong direction for a long time. As Gerald said, we almost have to have a major crisis here. We have to wash out a lot of unproductive debts and zombie companies. It's the only way out of this, and we need to do it now for the next generation. I'm a baby boomer. I was born in 1953, probably like many people in this audience, and that 37 to 61 was the rising tide of the baby boom births, the largest generation in history, okay? The millennials are not going to be able to see the fruits of their boom if we don't get rid of all our garbage. And all of this excess is debt and stimulus that's occurred even more unproductive investments and bad debts, okay? So zombie companies and unproductive debts are off the charts, and money velocity is the best single indicator, and it all says look out. So let me just give you the rundown of my forecast, what I see happening. And this is shocking. And people have heard me before, it won't be so shocking, but you haven't, it's shocking. But to me, it's the only real reality I see after this much overstimulus and after demographic trends in the developed world, not the emerging world. The developed world have peaked almost everywhere except for a few places, small places like Australia. Okay, just to go back to the early 2009 stock lows. Not that far on, not all the way back to 82, the beginning of the boom. That's all I'm projecting is going to happen. That is not minus 92% from the top of the NASDAQ, 86% for the S&P 500, and for the ASX 200, you lucky bastards, only 58%. Now that sounds bad, but wait until you see everybody else. And of course, the Nikkei's already been destroyed before our eyes and nobody paid attention to it. Their peak was at 40,000. They will never, ever see that again. And I said that right away. Japan was the first developed country to peak in their baby boom demographics and to go down. And they had the debt bubble of the era back then. And they never allowed their debt to deleverage either, just like we're doing. And what has it done? Japan has grown zero ever since. Australia, okay? Real estate, that's where it hits us the most. You guys did not have a real estate bubble crash like the US did. Even Canada didn't as much. So we have about a 50% downside by my very best calculations, and that's just going back to the 2012 lows. So we're not going back far. These are not, oh my gosh, we're going to erase all the gain. No, this is just going back to 2012 in Australia and the US. Sydney, 50% best expectation, 60% worst case. 60% for real estate to go down in Sydney. Melbourne, 45%, 55% worst case. Brisbane, a little better, 33% expected, 40% worst case. Adelaide, 30%, 33% worst case. 8 city index in Australia, 45% decline, 50% worst case. That is going to be the biggest shock to Australia. You are going to come out of the next few years, and this downturn would have naturally bottomed in stocks late 2022, the economy 2023, most globally in the developed countries, but they pushed it off. My best estimate, and this is good guessing here, mid 2024 before stocks bottom this time, okay? And they peaked January 4th in the S&P 500, November 22nd on the NASDAQ, our small caps in the US, November 8th, Australia, between, I think, February and April 21st was the last peak. So you're the last to peak, which is a good sign of strength, but it just means you have more to go down, but you don't have as much to go down. So biggest number, Bitcoin, got to talk about Bitcoin. I said Bitcoin might could go to 50 to 100,000, but it is going to go down 95% before it ever booms again. And it's gone from 69 down to 17,800, I think. Already gone down 70%. And my projections, just going back to the last set of lows after many years of an extraordinary boom, just going back to the late 2020 lows, it's going to be down 95% to 3,200. Now, might be a little less than that, whatever. So Bitcoin is going to crash. People are saying Bitcoin is a safe haven. Bitcoin was the biggest bubble. The dot-com stocks and stocks like Amazon were the biggest bubbles in the first tech bubbles and crashed the most. Also 95% Amazon. So that's what we're looking at. Bigger the bubble, the bigger the bust. This is an everything bubble for the first time in history. Before, the first stock bubble was 2000, but real estate didn't bubble until 2006, and real estate bubbled because people got killed in stocks and started speculating in real estate. Everything. Most countries in the developed world, stocks, real estate, bonds, everything are peaking at the same time here. We've seen, just to summarize and end here, what I call the first crash. First crash is important. If it's only 10 or 20%, that's not the first crash off of a bubble. History says 28% minimum, 50% maximum. Well, the NASDAQ went down 35% in this first crash. So I say this bubble is burst. There's very low chance we make a new high in the US. And if we don't there, it's only worse in most other countries, okay? So that's the thing. Huge downside in stocks. The biggest downside, we'll see, real estate never goes down as much as stocks, but real estate is financed by mortgages, and therefore that leverages it. And real estate is more dear to our hearts, and almost everybody owns real estate, and not everybody owns a lot of stocks. So this real estate bubble is going to be the hardest thing to hit Australia out of the whole thing. The United States is going to be whacked all around because we're so heavy in stocks, and stocks is such a big business here. But that's it. This is, and I've been saying this is not new stuff because of COVID. COVID has nothing to do with this. It just was a distraction, and it got the government to print $10 trillion in 2 years. This is going to go as the stupidest thing. You're going to print $10 trillion to fight a short-term virus that just makes people a little sick and then goes away. The same thing happened in early 1920s, influenza. It hit for a couple years and went away. We have a track record for this too. This was the stupidest thing, but why did central banks do this? Because they've been pumping up the economy nonstop since early 2009. They know how fragile it is, because why would they have to keep stimulating that much, that long, if the economy wasn't dead? They're reviving a corpse. So they know how weak it is. So they got scared and they really went overboard with COVID. And that was their classic mistake. There's no way out of this for me now, okay? This is forcing them to tighten. Once you start tightening, you can't just turn on a dime without looking like, oh my God, the economy's really weak and stuff. It's hard to do that. They won't do that on a dime, very unlikely. I think the die is cast. First wave down, 35%. We bounced, 50% retracement, perfect stock pattern. We're in the third wave now. Here's the last thing to remember. My important number today, 10,565 on the NASDAQ. That's the lead bubble index in the world, in the United States. That is where the first wave bottomed. Once we crash through that, this third wave will be stronger and harder, and it'll be followed with another wave after that over the next couple of years, and we will be in the greatest downturn crash of a lifetime. And all you have to do as investors in businesses, you just hunker down, cut your overheads, cut your costs, get lean and mean now, and you will be one of the people that don't go into companies in your sector. Investors, get out of risk assets just for 1.5 to 2 years. That's a short time to miss some potential gains when the downside, which I described today, and Gerald and a lot of other people on this panel, and by the way, this is the best panel I've been on in many years, so congratulations to Go Kyle on that. This is the time to worry about the downside. This is not a correction. It's not a drill. Get out of risk assets now. Any real estate you can sell, sell. Certainly if you have a vacation home, you don't use that much, okay? Stocks for sure. The more you get out of risk assets, the more you get into liquid. Oh, and where do you put your money? What? And then look at the research. Look at the early 30s. Look at 2008 to 9 crisis, and that's the best comp for this. What was the one asset that went up? High quality U.S. Treasury bonds, and yes, Aussie 30-year, 10, 20, 30-year government bonds as well. I would take the treasuries because the dollar is going to get the biggest boost. The dollar was the safe haven in the last crisis in the late 2008. But the high quality U.S. Treasury bonds, longest term possible, TLTs and ETF, the 20-year average, ZROZ, Z-R-O-Z, 25-year. You can buy 30-year Treasury bonds in the U.S., 30-year Australian. You want the longest bonds because they will be the safe haven, and the longest term duration bonds will appreciate the most in the crisis. And the last thing I'm going to leave you with, because you can't forget this, I'm not telling people to buy these Treasury and Australian bonds forever. It's the safe haven. And I'm going to have to disagree with some people here. It's not gold. Gold did better than other commodities in the last crash, 2009, but it still went down 45%. So gold's not a bad place to be, and I wouldn't mind having some of it, but that's not the safe haven. Treasury bonds, highest quality long-term bonds, including in Australia, are the place to be. And then you get out of those because they have low yields and they will not do well in a boom. Then you get back in stocks, and in Australia, in the whole Southeast Asia, kind of everywhere your part of the world is going to boom the most. Europe will never boom in the next boom like they did before. US will do good, but not as great as in the last boom. You are in the right part of the world. Preserve your money now, and then you reinvest in the best stocks and sectors around mid-2024. And I'll live long enough to give you some better timing on that when we get there.